Our presenter is a fellow of both the Association for Chartered Certified Accountants and the Institute of Chartered Accountants in England and Wales. His principle is that focusing on your goals, blended with his foundation of strong accounting and tax expertise, makes the difference between the success and failure of your business and personal ambitions. His approach is holistic. By really getting to know you from the base level up, he can tailor advice, unlock opportunities, and help you to get where you want to be. His skills, built up over decades in practice, help clients ranging from £100 million turnover groups to smaller family-run businesses and tech companies, and he's really focused on getting their numbers working for them, so which is why he's an ideal person from Davis Grant to present on today's topic. Welcome, Neil Driver.
Thank you very much, Nick. A very nice introduction. It's a fair bit for me to live up to. So for those of you, I'll just crack on with a bit of introduction about Davis Grant. For those of you that don't know Davis Grant, we're a firm of chartered certified accountants based on the Essex, London, East London borders. When we're allowed to open the office, that is. There's about 40 people in our team, and all are highly qualified. Our core business is to advise what I call active owner-managed businesses, helping with all of the aspects of their tax accounts, bookkeeping, business and personal planning. And it's a bespoke service tailored to individual clients' needs. Our core values are being one family, to champion integrity, always being here for you, exhibit professionalism, and to have unequivocal excellence. That's where we stand. But before I start and get into the details today, I thought I'd share a thought for the session, which is up here. The budget is not just a collection of numbers, but an expression of our values and aspirations. So hopefully you've all updated your budgets and forecasts to reflect what COVID is happening to our businesses and out there. And the start of New Year is often when people revisit those numbers. But those numbers should be aspirations for your business and yourself, which are inexorably linked over the next 12 months. But now in this, we want to give you time to make sure you can understand, know how to monitor and measure what you've set in those budgets. So this webinar is about demystifying some of the most common reports you should be seeing on a weekly, monthly or quarterly basis or annually, so that you're more in control of your business performance. Over the next hour or so, I'll be doing mainly presentation, and then as Nick said, we've got quick Q&A session at the end. So please do put those questions through as we go through. We'll cover the importance of knowing an overview of the different reports that you should be producing, the difference between profit and cash, and key drivers of business value. We'll touch on how to protect your assets and also how to adopt best practice. And then always want to outline some potential next steps for you to make sure you truly get to understand what's in your numbers. So take plenty of notes. Some of what we talk about might be a bit foreign to you, perhaps a bit accountancy-ese. I'll try and avoid that. And some of it will really sound more familiar. It's not intended to be a real deep dive into the numbers, but an overview so you can appreciate the key elements of what you should be seeing. So as I say, do send through your questions at any time for us to answer at the end. So why do you need to know your numbers? Well, knowing your numbers is vital as it allows you to interpret where you are, if you're on track relative to goals you've set in your business plan or business recovery plan. And here's my 6 top reasons why you really do need to know your numbers. Firstly, they tell the story of your business and they allow you to interpret the results of what's been happening in your business activity. Secondly, you can identify symptoms and root causes. For example, a decline in gross profit might be a symptom of many root causes, such as ineffective pricing, doing things more than once, or poor purchasing and wastage. Knowing your numbers will enable you to spot an early warning sign of a potential issue that could grow over time if you don't look at it. For example, monitoring how long it takes customers to pay. That allows you to respond quickly, and monitoring allows you to respond quickly if numbers start to change. Areas of strengths and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. And understanding your numbers also means you'll have a reliable financial information to base your day-to-day decisions on, and larger strategic decisions as well. And finally, knowledge is power. The more you know about your business, then the better your business will be. So that's all quite apparent and basic stuff. The key reports that we'll be looking at today, we'll be reviewing each of these to help you understand and learn from them. We'll work through an example on each, and I'll show some key learnings and things to look out for in your reports. And in this, we're going to use a fictitious company called Foods Company. Don't know why, I'm not feeling particularly hungry, but that's the way it is. And we use that all the way through the examples. So the first first report we're going to talk about is the trading account. Now, the trading account tracks your sales, variable costs, and your gross margin, which is the return you're achieving on your sales before you take off fixed overheads. It's often the first several lines on what is called a trading profit and loss account, which usually presented together. Certainly in your full set of year-end accounts, it will undoubtedly be presented at the top of that part. So don't always look for a separate report, because frequently it's part of a combined one. Your gross profit percentage indicates to you whether your margins are improving or deteriorating. And you can track your results through this across different divisions, if you like, to really refine your bookkeeping and reporting, or different product lines, different regions. You can have a trading account for each of those to drill down further into the business if that's relevant to you. And small adjustments in the trading account can have a huge impact on overall results, and which I'll demonstrate that now. So this is a company. So you can see they've got just over £1 million worth of sales. Their direct costs, which generally stock and so on, were 318,000. Other direct costs, wages, development expenses, materials, 450, which left them with a gross profit of 248,000, which is a gross profit percentage of 24. The gross profit percentage here is talked about as a percentage of the gross profit at the end compared to sales. Now, let's say the company undertakes some coaching with their accountant and implements some strategies to increase, for example, customer retention rate, which would result in increased sales of 10%, and also work with their accountant to review their stock or unbilled time processes and reduce cost of sales by, for example, 5%. And on top of that, look at maybe renegotiating with some suppliers on delivery costs and reducing those, in this example, by 5%. So we can add those through and look at what a difference those percentages might make in this example. And we can see that when all those differences track through, we've increased margin quite significantly by 140,000, up from 24% to 35%. So I'm just demonstrating here that understanding what's going on in your trading account which is the day-to-day production of the business. The direct costs that are associated to sales can have a big impact on the profitability of the business, and making small changes can also have a big difference. So if we move on from the trading account to the profit and loss account, or an income statement, that looks at your bottom line earnings and costs over the year and tracks the overall performance of the business. So we're matching the expenses for the period, and we also look at timing differences. For example, sales that may have been made but money hasn't been received yet, or work that you have done in a period that was billed afterwards. All those are adjusted for in your profit and loss account. But it's important to remember that profit is not the same as cash. Obviously, profit includes non-cash expenses such as depreciation and loan repayments and so on. And you've got to make sure you're generating sufficient profit to cover your cash costs, asset purchases, and perhaps drawings too. But so your profit and loss account provides a framework to benchmark your results. You can use percentages or comparisons between years or quarters to compare your business to what it's done in the past, or even to similar businesses if you can get the data to compare. Also, businesses, when you talk about business valuations, they're generally valued using a multiplier of earnings. So profit and loss account, and what ends up in the bottom there, is a fundamental driver of the value of the business. The higher your earnings, the higher the value. So this is an example of a profit and loss account using the same fictitious food manufacturing company. So we've taken the gross profit from the trading account, and then we've listed all of the expenses that you normally see. Unfortunately, though, this one is starting off with a loss of 113,000. So if they looked at a few expenses in a review, and you look at some savings, we've just got a few, maybe look at your insurances at the moment, or see if you can get a better deal on some rent with the landlord, or cut out some unnecessary space. Those are just a couple of the examples we've put here. So just saving a bit of money in the overheads. Again, percentages can make a difference as they add up. But in this example, you'll see that accountancy fees have gone up, and that's just to illustrate that in the previous example, that this company is now engaging their accountant in more coaching and advisory services, so that extra investment is shown in there. But despite the increase in that, the overall net surplus has increased by 138,000. Including the increase in the gross profit above. So that's the profit and loss account. Moving on to the balance sheet. The balance sheet, also known as a statement of financial position, it's a snapshot of the business's financial position at one specific point in time. So whereas the profit and loss, trading profit and loss account, cover a period of time, a month, quarter, year, whatever it may be, that would end at the balance sheet date, just one date in time. And the balance sheet shows the net worth of the business, which is the assets less the liabilities. It can also show if the business is solvent. For example, if your liabilities are greater than your assets, then the business is insolvent, and you've got to take urgent action to fix it. You can compare different periods again and look at whether the business net worth is increasing or decreasing between years, and track the strength of the business through looking at the balance sheet. The stronger the balance sheet, the more positive it is, the easier it will be for a business to survive in a downturn, because it'll have more reserves and assets to deal with a dip. You can also use it to calculate key ratios, such as debtor days and stock and unbilled work days, which I'll show you in a minute. So this is a presentation of the balance sheet. We've got total assets and liabilities presented down the page. The current assets, which we're showing here, are bank. Trade debtors are people that owe you money from your sales invoices, and inventories is stock or unbilled time. And this is a total here for those, for what they represent. Further down, we're looking at the liabilities, and current liabilities are, and current assets are a categorization of everything that's due within 1 year. So down here we've got, you can see we've got bank, which is overdraft and credit facilities, whereas further down the balance sheet we've got loans which are due in more than 1 year, so those aren't shown as current liabilities. But a key measure here is to look at what is due within 1 year, and that can tell us about solvency. So here the company owes more within 1 year than it's got due in, and so it's going to have a cash flow problem. And if you look more carefully, you can see that its trade creditors, and just picking two simple figures here, its trade creditors, 96,000 odd, are more than its debtors, so it's got carrying quite a bit of stock. But when you add everything up with some other bits and pieces, the company's going to have a cash flow problem. So check for your overall net current assets. And at the bottom of the balance sheet, it's going to show you everything that is the current assets, the fixed assets here, property, maybe some goodwill and some branding or such like costs, less loans. So this company's got a deficient balance sheet overall, which needs a bit of fixing. So perhaps over the long term they could implement strategies to reduce how long people owe the money for, renegotiate with their suppliers, to push various factors out to make the company run smoother. So one of the things I said we'd look at is debtor days. Now, a way you can work out your debtor days is to look at the total amount that you're owed in from your customers, divide it by the turnover, which was the number we showed at the profit and loss account, and multiply it by 365 number of days in the year, and that gives a number here of 26. Now, if you really wanted to get picky, this 72,000 will include VAT, and the 117 will not include VAT, but generally that's not adjusted for, and it gives you a figure here. So if you wanted to come up with some improvement ideas, and you could increase your credit collection, your credit control, and change your terms of engagement with your customers, perhaps bring that improvement down by, in this example, just 5 days, you're going to be able to save £13,000. £14,000 is going to come in quicker to the company than it otherwise previously would have done. Similarly, you can work out a same kind of ratio for stock or unbilled time, and taking the figure there, dividing it by the total costs for that in the year, and using the same 365 days, comes out with a number of 74. So this is indicating that this company is carrying 74 days worth of stock or unbilled time, which they're carrying and not holding up cash flow. Similarly, if they can look at reducing that, get a better billing basis, better stock control, then that's going to bring in £7,000 or £8,000 worth of cash if you can reduce that by 9 days. So the two added together, it could increase cash flow in this scenario by about £22,000, which doesn't fix the solvency of the balance sheet, but it demonstrates how looking into the balance sheet and trying to work out what's happening with those numbers, how you can take action with what's going on in the business. At the end of a balance sheet or in the notes of the account, sometimes you have what's called a statement of change in equity, and that shows total reserves of the company or what is available to be spent out or voted out as dividends if it's positive. It represents the net worth of the company. It's a key indicator of what's going on. Sometimes you see that at the bottom of the balance sheet. Sometimes it's not even presented, but it's worth looking at. If the company is insolvent, it's going to be negative, as in this case. So sadly, this company's got accumulated losses for the past few years and no retained earnings. So there's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. Obviously, directors have got to take action now to increase the profitability and should take advice on how to do that. On dividends, which I've mentioned a little bit, it's important to note that only when the company's got positive retained after-tax profits can it declare and pay dividends. It's illegal to pay a dividend without reserves in a company. And in times when profits are uncertain and the directors are not clear if there's available reserves from which to pay a dividend, it's vital to have a reliable set of management accounts so that informed decisions could be made on those. And there's also an overlap in law about directors' liabilities and the veil of incorporation if you are protected from creditors if you're paying out dividends when you shouldn't do. So it's really important from that point of view to have a balance sheet at the time you're looking at paying dividends. A positive balance sheet, I should say. Another document that you will come across is called the director's current account or loan account. It's all the same, and they record funds introduced into the business by the directors and records those taken out, drawings, expenses, dividends, and so on. So it can help monitor the personal expenses from business, or for businesses with more than one director, you can keep a balance of what has happened with each of them and who's introduced and withdrawn what. Shows how much the business owes or is owed perhaps by a director. And if the director owes the company, if it's overdrawn, it means they've taken out more than they've put in or more than they're entitled to. And to put the account back into balance, into a positive balance, then director can inject money to repay the loan, or the company can increase dividends or bonuses so that it can be put back into balance. And similarly with dividends only being paid out when reserves are positive, it's important to make sure if your director's account is overdrawn that you get advice from your accountant as soon as possible to discuss what options are there for you and your business. There's also significant tax costs. I'm not going to talk about tax in this at all today, but worth noting that there's significant tax costs and effects of not clearing an overdrawn director's account within strict timescales. So this director's account is quite simple. Started with 29,000 odd, put in £2,078 in the year, and then took out some money, paid some expenses, and just ended up with a balance at the end of the year. But similarly, if he wants to take that money out, the company's got to check how that works with its cash flow and make sure that it's solvent when it's done. Another document is your fixed asset register or the depreciation schedule, and this records businesses' fixed assets such as vehicles or plant and equipment, and shows how you spread the cost of that over their useful life. It's a basis for keeping track of the business assets because they're listed out, and it's useful as a guide to see when assets need to be replaced, so there can be budgeted for and so on. It's also useful when selling a business because it records all of the assets that you've got and the current value of them all. There will be a note in the accounts which shows the fixed assets as a total, but this would be a sheet behind it that shows and lists every single one. So here's an example of a fixed asset register. The first column shows what the asset is and when it was and its cost. And the next column here is showing the opening value from the previous period. Then we're adding in purchases or disposals, and a disposal could simply mean that an asset has reached the end of its life and no longer holds any value, so you're taking it out of the list. I would really leave them in there because it's useful to know what you've got. Perhaps move them down onto another tab of fully depreciated assets you've still got. Then you can look at what rate you're going to have for each asset. Different assets will have different rates. Vehicles, software is often written down quicker than hardware, and there's different rates for different machines going on here. I would have thought that's fairly complex, and it isn't always necessary to be as precise as this, but if you have a fixed asset register, it gives you the opportunity to really consider what the useful life of each asset is, and if that asset is expensive or material, it can make a difference to your results because the depreciation is recognized in your profit and loss account at the end of the year. So if, for example, you had a standard depreciation policy of 25 or 30% for fixtures and fittings, without considering each one individually, then this asset, as an example, you'd be charging twice as much depreciation as you might need to. So then the depreciation flows through in the year, or you can have it per month or quarter, depending on what you want. And then we show the accumulated depreciation closing net book value. And so the closing net book value will be the figure that shows on the balance sheet at the end of the day and ties up with the management figures. So this sums up, those are 6 key reports that you should be producing and reviewing regularly. Each report tells a different story about your business and aids your decision making in a different way. I hope I've just shed a bit of light on those for you. If you've got questions about them, send them through and we'll answer them shortly. In the meantime, I'll move on to understanding the difference between profit and cash. It's common for business owners to get frustrated that what goes on in the bank doesn't seem to reflect what's in the profit. But it's essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in the bank. A profitable business can go out of business because it's starved of cash. And running a business at a loss can survive because it's got access to business from funds and investors or financiers. In other words, the cash flow is really the business reality. And most of you that are in business will live and breathe that anyway. Excuse me. So I just want to go through to demonstrate what may be profit and what may be cash, just to highlight some of those things for you. So VAT is only a cash item, doesn't affect profit at all. Loan repayments, they affect your cash balance but not your profit. Interest on loans affects both. The interest goes to the profit and loss account, but the capital only goes against cash. Asset purchases only affect cash. Asset sales affect cash, and depreciation, following through from what we were talking about before, only affects your profit. So you can see that even if a business achieves a healthy profit, there may not be enough cash in the bank after paying VAT, loan repayments and so on to help the business survive. So that's just an illustration. There's plenty more of that, but those are some key items there. What we call the Business 101 cycle is another useful way to demonstrate the difference between profit and cash. So at the very start of a business, money is invested in, or at any time money is invested into the business. If you know, for example, all the bounce back loans that people are getting at the moment to keep it going, or various other funding. That's used to purchase assets and pay bills to generate income. But the business may need additional funding at various times to buy assets they need, might take new loans to do that. These assets are then used to generate profit. And as we talked about earlier, you can increase your profit by looking at sales or margins, but overhead expenses obviously drain that down and can result in a loss if they're not managed. Then the profit gets turned back into cash, and drains on your cash can include, if you're not collecting your debtors properly, high stock, not billing time quickly enough, repaying your loans if they're onerous, paying your tax, and payments to suppliers. But you can get gains to your cash by getting your money in quicker, being cleverer with stock, longer payment terms to suppliers, and looking at ways of reducing tax legally, of course. The owners can then take cash out of the business that it's generated as drawings or repaying money they've injected in the first place. And then the cash is reinvested back into the business to generate more. So this is just a nice way of seeing how the cycle works. And obviously, an aim of business is to spin that wheel as quickly as possible so that return on investment grows and grows. But after cash flow, business value is a really important measure of business success. So part of knowing your numbers is to understand and measure the drivers behind your business value. These drivers might be monthly recurring measurements of looking at your monthly income, how that is growing each month, all the sales, profit, cash flow. But there's a difference also between what I call leading and lagging drivers. Accounts is often they're a lagging indicator, so they're an indicator or a key driver after the event, but you've also got to look at leading indicators. So drilling down into sales cycle, for example, an indicator might be, you know, your lead conversion rate, or how many proposals you're putting out in a month, or how many advocates you're actually going to meet and greet when allowed, or phoning them. So it's important to know the particular key drivers of your business which underpin all the figures that we've been talking about, because the figures that we're looking at are all historic. So they're lagging indicators, and you can't really do much to change them. It's important to look at the leading indicators within the key drivers of your business. To enhance the value of the business, you really got to have a clear plan. Look at your organization structure and roles within your business, and to get your good numbers at the end of the day, you should really be looking at cloud-based real-time reporting, which through new, well, not so new software, pretty much standard software now is available, and it allows you to make better day-to-day decisions, and reviewing them is important as part of this process, because that will help you run the business as efficiently as possible. If you can reduce the reliance on yourself, that's going to enhance value. To reduce the reliance on the business owners, and looking at managing risks can mean those can be mitigated before they become an issue, and those risks can come out by looking and drilling down into your financial statements and the figures we've been talking about. Looking at them, understanding them, and taking action can help protect your business value. But just moving on to protecting your business assets as a whole, the profitability, cash flow and value of your business affects business owners personally. If your business isn't profitable and you haven't got much cash available, you'll not be able to pay yourself and fund your desired lifestyle. So there's a few other things that you can do as well as looking at your numbers, which I just want to touch on quickly. So make sure that your business is set up properly as a limited company if necessary. Consider who the directors are, make sure that people with responsibility are properly shown, and those that don't, then maybe there shouldn't be a director. Check what security you've given out, and if you need security over money that you've lent to others. Look at alternative ownership structures for high value assets. For example, if your business owns the commercial premises that you use, think about moving ownership to a separate company. There's tax implications of that, but it's important to check and plan what can be done. Look at your terms of trade and credit policies to ensure that you only give credit to customers who are likely to pay you. And that's even more important at the moment, as we're likely to move into, or we are in very tight times, and recession is going to bite sometime next year. So you don't want to be giving credit out, and bad debts can be incredibly expensive if they hit. Look at your insurances to make sure you've got sufficient protection. For example, have you got business interruption insurance? That's been in the news quite a lot recently with possible COVID cover or not. Your indemnity, make sure that your business is covered for as many adverse events as possible. Check your financial planning is in place for your personal wealth, pensions, investments and so on. And finally, don't forget about estate planning. If you've got an up-to-date will, powers of attorney, and a clear plan for transferring your assets through to the next generation. It's not an exhaustive list, but they're just some of the ways you can protect both of your business assets and personal assets. And we can help you look at any specific ways for you individually. But within the numbers and looking at them and understanding them, it's essential that you adopt best practice all the time. So how does everything I've talked about today come together as an action? So every business should really have 3 essential tools. Your annual business plan, or possibly a business recovery plan in these times. And the business plan is going to really map out what your plans are in writing. Then your annual forecast, that's the numbers that go to back up the business plan. And then behind that, ongoing reporting and accountability. So the reporting ensures that the numbers you want to achieve in your plan and forecast are being measured. But that without accountability can sometimes fall short, because business owners don't necessarily look at the reports or are not held accountable, if it's a small organization, for reaching their goals and keeping on track with the plan. So accountability in some form of coaching or mentoring, using an independent coach to hold business owners accountable, really works for adopting best practice and drilling into the numbers and fully understanding what works and using those key drivers to move the business on. So using your numbers and understanding them is just the beginning, and it allows you to improve them and ultimately achieve your goals for the business. So what are your next steps? Where do we go from here in these challenging times, as everybody says? Well, my aim is to help you take what you've learned today and implement some positive change in your business. So now is the time for you to decide what you're going to do. What I suggest to do is take just a few minutes now, whilst it's in the forefront of your mind, or after the webinar, to write down just 3 actions or projects that will add value to your business. feel free to send them over to me. I'd love to share and discuss them with you. A full goal setting session is a whole other topic to cover another time, but having just 3 key actions from today will be invaluable to you and really make the most of the time we spent together. Doesn't need to take long at all, but please do find the time to do that immediately. You can think about perhaps what problems you may be experiencing in your business or things that keep floating through your mind at night. Write them down, identify them, and use them as an opportunity to create a project to fix them. If it's about understanding your numbers more, make time, and that's obviously important to you. But you've really got to do something. Doing nothing right now shouldn't really be an option. How can we help you? So after today, I've got a list of things here that we are very happy to share with you. First of all is a numbers review. So that's really an hour and a half or so session with you to sit down, if we haven't done it with you before, and explain your numbers, drill down with you, look at them all, and look at the key numbers that are important to you, identify perhaps a few key drivers within the business, and leave you with an action plan of things to do. It's a power-packed hour and a half. Normally that's £410, but today, as a thank you for joining us on this webinar, that is reduced down to 290. And there's various other things that I'm suggesting that you dip into. We can do a specific goal setting session, look at a whole business recovery plan, look at where you are now, look at where you want to be going, and map out how you want to be doing that, looking across all different areas of the business. Customers, suppliers, personnel. It's quite a detailed, complex thing, but it'll help you map out where we need to go. Cash flow forecasts, getting the numbers for the next year or so mapped out in a monthly way with a profit and loss account you can measure, balance sheet you can measure, and we will even have a cash flow forecast so you can see what should be going in and out of your bank each month. It's a great thing to have, and then you can measure what's actually happened against the budgets and really start to understand why your business isn't operating as you had hoped and planned it should do. Mentoring, we're very happy and sit down with clients often to go through all kinds of aspects of their business. That can be quarterly, monthly, whatever rhythm works, but I would suggest no longer than every quarter because it's not effective. Management reports, if you're not getting management reports regularly out of your accounting system, it's really vital that you do that. And if none of that hits, or some of it hits, or you want a blend of it, just get in touch with us to discuss how it is we can help. Very happy to sit down and talk with clients, of course, and non-clients. Please do get in touch. The numbers were at the beginning and they'll be at the end of the presentation as well. And that really is the end of the presentation as it stands. I hope it's difficult. I know it's difficult to commit spending money right now on some of the things I've been talking about, but there's always a great return on them from the process over time. So we've got different payment options, so don't let cost be a barrier. Get in touch and we can work to come to some arrangement that you can manage. We know the benefits of the services that you get from us will be far greater than our fee, but more importantly, it's about helping you as quickly and as possible to make sure we can work with you to get a stronger, more sustainable business. Today's information was generic and is no substitute for specific tailored advice and support. One-on-one, we can identify most important things for your business that will make the biggest impact. So that's it. In the remaining time of a quarter of an hour or so, we'll look to the question and answers and see what's come in. So, Nick, have we got anything that...
well, no, I just wanted to say thank you very much, firstly, Neil, for that really informative session. I was taking notes along and I've got some general notes to everyone here. Just to say that in the chat there is a link to the slides. If you want to download those slides that Neil was going through, which really highlighted those key numbers to pull out of your accounts and your paperwork. And I will be in contact with you all after this session, just to provide the tools. We've got a tool to offer you, and also the slides, and the webinar will be available as a recording if you want to share it or re-watch it and really go along with your through the session again with your accounts in front of you. Obviously, as Neil said, if you do want people to actually just come and if you want us to go through that with you, you've got the options there. So if you struggle, please do just reach out. Which brings me on to a question, Neil, which was, I just, in the early part of the session, we were going through a lot of these documents, and I was just wondering, where would firstly, well, Davis Grant clients, but also then people who might have their accountant, and they might say, well, I see the accounts once a year, but I don't really have them to hand. How would you advise people to kind of really get hold of them there?
Well, how to get hold of their numbers?
Yeah, or even just the source material. Is it coming from your accountant? It's
Yes, I mean, it can come from different places. It depends on the size and sophistication of the business. The year-end accounts usually come from the accountant, but management accounts and figures during the year, and a lot of the things that we've been talking about should be measured throughout the year rather than just at the year end. So you should be producing what I refer to as management accounts, which are accounts at monthly, quarterly, whatever period works for you through the year. And those accounts would come from your accounting software. Those can be produced internally, but they've really got to be meaningful and workable and reliable. They need a bit of a sense check. And when we work with clients, they can produce them and we can check them, or we can produce them from the software. But someone needs to get them out from the accounting system on a regular basis.
Understood.
So the management accounts are becoming more accurate. More accurate is an important thing with the way that the government is driving submissions for VAT returns using Making Tax Digital. They're moving to a process of not just submitting your VAT returns, but submitting ultimately, and some businesses do now, all the underlying transactions that go to make up the VAT return. And they've been very open, saying that over time they're going to compare each quarter to the year-end accounts and not want to see any significant adjustments between quarterly reporting and annual reporting. Now, this hasn't flowed back into business yet, but it will do over the next few years. It's been pushed back because of technical issues, business issues, and now COVID, but this is coming. And what it means is that businesses don't want to be submitting their VAT returns before they've done quarterly management accounts. And those quarterly management accounts need to be accurate. So this is really a tax issue as much as it is an accounting issue, but the revenues through their process are almost forcing businesses to take management accounts more seriously and make them more accurate. And that comes back to something I was talking about improving systems, improving how you're keeping your bookkeeping. That is a fundamental thing behind getting these figures. All of the forecasts are great, but you're actually measuring what's happened is only down to the accuracy and how good your accounting systems and your management accounts are. Now, you can run your accounting system in-house to whatever level of expertise you've got and press a button and produce management accounts. That you can get them out of software, but really without a sensibility check and making sure that they make sense before you take decisions on them, is probably a dangerous place to be. So that's where we or your other accountants would step in and make sure that those management accounts are accurate. And tying that back into the Making Tax Digital thing, in a company's annual accounts, you often get more precise adjustments for things like income recognition. If income is not invoiced in at the year end, look at what's happened, and cut off of matching expenses and income and stock and so on, and getting things as accurate as possible, perhaps loans and recognizing interest and HP. A lot of businesses leave that to the year end, but with management accounts, you really want to be doing that on a quarterly basis. And it might sound a bit more onerous, it probably is, but once the systems are set up and it's understood what needs to be done, then you can get those processes going within the business quicker. And if you get that going quicker, then your year-end accounts can come out quicker as well. So it's just really good accounting practice. And I think over the coming years, because of what's happening with VAT, Making Tax Digital, that's going to drive businesses towards this, which is only really good practice anyway. So I hope that answered the question. A bit of a long-winded answer.
No.
But yeah.
I think we all understand that things are being digitized, and this HMRC push for making tax digital and online submissions rather than forms and almost a direct link into our accounting software seems to be inevitable. Yeah. Neil, do you think that the current situation with the coronavirus and the pandemic has accelerated things? Has it got in the way? There might be people on the call who aren't Davis Grant clients who've maybe feel they've had trouble getting in contact with their accountant. Do you think it's
okay? I think the last year has kind of thrown things up in the air for a lot of businesses, and accountants and businesses have coped in different ways. And I think in a way, as the situation unfolds, it'll continue to happen. Our systems were very much on the cloud, and we had team members working remotely. For us to go fully remote was, I would say, as one of the partners, it was challenging, but we managed, and we started pushing out loads of information to clients and doing webinars and really turning up support for our clients. And I like to think that throughout it all, we've really stepped up and been here for them as much as we could, and we had a lot of great feedback from that. But like from today, I'm really just trying to demonstrate that I think it's important for businesses to do the key things that we were talking about today, more so than ever. And if you're not getting support with that, with your forecast business plans, they're in one sense essential, and they're not always difficult to do, and they can add a huge amount of value to the business and to the managing of the business and to making important decisions. I think now decision making is going to be quicker. And unfortunately, I think decisions are made and remade as the situation changes. Things are not, there's not a level playing field at the moment. And I think the support from an advisor is more important now than ever before. Yes, it comes at a cost, undeniably, and that is difficult for some businesses. But as I said during the presentation, and perhaps some cynically would say, I would say it pays off. It does pay off, and even the mentoring or having a trusted advisor to rely on, an ear to bend about things that are not necessarily the numbers. That's what we're good at with helping our clients with. So yeah, it's an interesting time out there, interesting for the profession. You said that things stopped. Yes, some things have stopped because the government's been overruled with COVID and Brexit, and the revenue have had all kinds of stuff to deal with. People are down on staffing, resources are being stretched. So things that were on the back burner or on the front burner have been pushed back. But equally, there's things that have been in the pipeline for a long time that are still going to happen. There's changes in off payroll working rules coming out. There's changes to do with something on VAT and builders reverse charge, which is quite complex and difficult. Those have already been put off a year. We're now almost in the second year of putting things off, and I don't think that things will continue to be put off forever. The government's got to move on, the revenue's got to move on, and businesses are going to have to deal with it. So I think at some stage things are going to start, pushing on again.
So I guess your message to everyone watching is not to be shy about getting in contact with Davis Grant or with whoever their accountant is, and because now's the time to be seeking that help, really. If you
100%. And in the context of today's presentation about knowing your numbers, it's more important than ever to really understand what's going on. You've got to know what's happening with your cash flow. You've got to know what's happening now and over the next several months, so that you can plan for it. Getting money when you need it can take quite some time. Banks are not necessarily forthcoming. There's all kinds of problems. They're swamped at the moment. You can't just phone up your bank and say, I've run out of money, can I have some more today? It takes months and hoops to jump through. So it's vital that you know your numbers, you know what's going to happen, you forecast what's happening in your business, and just be realistic. It's not always good news, I know that. Sometimes you have very difficult decisions to make. There's no point in burying your head in the sand and pretending they're not there. That'll just make things worse.
And there are things like the government loan schemes that have been extended, and grants that can be
a lot of finance out there still. We've got access to a finance platform. We've had great success getting CBILS loans for clients.
So we can actually help people directly access those loans.
Yeah. We've got a provider that accesses across a whole gambit of finance that's available. Several or more CBILS providers,
right.
and more regular financing for assets, property, whatever. It's a really kind of like compare the market
right.
for finance. So there's over 120 odd providers. It's a great way of cutting through the market, and quicker usually than going through the bank.
No, thank you for mentioning that, Neil. That's really
we're doing that quite a bit with clients.
Yeah.
So, but on your point, yes, take advice. Speak to your accountant. If they're not proactive enough, find someone that is. We'll always be happy to talk. But this is serious stuff for everybody. We've got recession coming. I think we're coming out of recession. There's all kinds of adages about more businesses go out of business coming out of a recession than going into it. And the reason for that is that cash flow dries up, kind of over trading, if you like. There's lots of things that your thing about things going on pause. I think some things on pause, but I also think some things are actually crammed into this period of time. COVID has been a weird thing in business for businesses. A lot of stuff has been pushed out, and a lot of stuff has been squashed in. The rate of change has been rapid. It's just there's a lot to say on it all.
And I know that from our current work, Davis Grant is always looking forward and anticipating things for their clients. And I know that we're looking to the budget in March, and there's very much the expectation that Chancellor Sunak is going to have to work out how to pay for all of these schemes and all of this public spending that's got us through this crisis. It seems like very interesting times. We're out of time though, Neil, but I will just very quickly say to Margaret, who has asked about I will just say, Margaret, you've asked for what free tools we can get. Sorry, Neil, go on.
just to pick up on that, yes, I think next month we're going to be doing a webinar on pre-year-end tax planning for the remainder of this year, which is going to be in advance of the budget. So that next month's webinar will not be looking at budget stuff, be looking at what we've got now and how to make the most of that in a proactive way. So watch out for that. And yes, we've got to pay for this. Tax is only going up at some stage, and that is a big thing in planning for clients at the moment as well.
Yeah, if that's not an incentive to get on top of your numbers, I don't know what is, if we're all being pinched in all these different directions. So to finish it, I just wanted to say, Margaret, who's asked about what tools we have for free. Yes, please do always check out our website. It's worth subscribing to our email newsletters where everything will be sent through. I will also be following up with everyone who was here on the webinar today to provide you with resources, and please just get in contact with me via that, or and if you want to take up Neil on any of his offers of those sessions, please reach out to us. Do you want to go on to the next slide? Next slide, Neil, to finish us off.
Yep, thank you, Nick.
Yeah, there's all the contact numbers and Neil's email address. So please do get in contact with us. We are here to help in whatever way that it is, even if it's just a short chat.
And also, just in terms of finding information, if you Google Davis Grant or search for Davis Grant in the App Store, we've got a great app with all kinds of stuff on it and resources on there as well.
Yeah, no, that's a really, thank you, Neil. Yeah, that's a really good way to have all of our expertise in your pocket, and you will receive alerts of future webinars and other announcements as they happen. So thank you very much, Neil, and thank you to everyone for attending.
Thank you, Nick. Thank you, everybody. See you soon, I hope.
Have a wonderful day.
Bye-bye.